Understanding compliance officer training, navigating the world of accounting principles. Introduction. Compliance officers and loan officers play crucial roles in ensuring financial transactions are carried out smoothly and within regulatory boundaries. In this comprehensive article, we will delve into the fundamentals of compliance officer training and loan officer training, focusing on the intricacies of dealing with funding through the Depository Trust Company, DTC, and the Depository Trust and Clearing Corporation, DTCC. We will also explore the importance of accounting principles in these roles, shedding light on their significance and practical application. The basics of compliance officer training. Compliance officers are responsible for ensuring that financial institutions adhere to laws, regulations, and internal policies. Here are key takeaways from the transcript regarding compliance officer training. Understanding Article 9 Security Interest. Compliance officers should be adept at recognizing and recording Article 9 security interests. This is crucial for maintaining transparency and legality in financial transactions. Accounting as the foundation. Accounting principles serve as the bedrock of compliance officer training. Two essential aspects come into play: accounting concepts and accounting conventions. The significance of accounting principles. Let's delve deeper into the significance of accounting principles, which are paramount for compliance officers and loan officers alike. Accounting principles defined. Accounting principles refer to the rules and standards that guide financial accounting. They ensure consistency and accuracy in financial reporting, making it easier for stakeholders to understand and compare financial statements. Generally accepted accounting principles. GAAP financial statements must adhere to GAAP to maintain consistency and credibility. Auditors certify that financial statements comply with GAAP, reinforcing their reliability. The nature of accounting principles. There is ongoing debate about the nature of accounting principles. Some see them as fundamental truths, while others view them as rules of action. The American Institute of Certified Public Accountants, AICPA, defines accounting principles as general laws or rules adopted as a guide to action. Essential features of accounting principles. To be considered valid, accounting principles must satisfy three basic norms. First, usefulness. Accounting records should increase the utility of financial information to readers. Second, objectivity. Principles must be objective and grounded in fact, free from personal bias. Third, feasibility. Principles should be practical and feasible in real-world accounting practices. Types of accounting principles. Accounting principles can be categorized into two main types. Concepts. These are fundamental assumptions and ideas that underpin accounting practices, often associated with public accounting. Conventions. Customs and traditions that guide the preparation of accounting statements, typically seen in private accounting. Understanding the distinction between concepts and conventions is crucial for compliance officers, as it informs their approach to financial transactions and regulatory compliance. Conclusion. In the dynamic world of finance, compliance officers and loan officers must be well versed in accounting principles. These principles, particularly GAAP, serve as the guiding light for financial transparency and credibility. Compliance officers should always ensure that financial statements align with GAAP, providing a robust foundation for their work. In summary, compliance officer training encompasses understanding Article 9 security interests and the application of accounting principles, with an emphasis on GAAP compliance. As financial landscapes evolve, staying grounded in these principles is key to success in the industry. Understanding key accounting concepts for public entities. Introduction. In the world of finance and accounting, understanding the core concepts that govern financial reporting and transactions is paramount. This article will explore important accounting concepts, particularly those relevant to public entities. We'll delve into concepts such as the entity concept, going concern concept, and money measure concept, shedding light on their significance and practical implications. The entity concept. The entity concept, also known as the equity concept, plays a fundamental role in accounting for public entities. Here's what you need to know. Distinct legal entity. For accounting purposes, a business is treated as a separate entity apart from its owners, creditors, and other stakeholders. Even the proprietor of an enterprise is considered separate from the business itself. Recording transactions. All business transactions are recorded in the books of the business, treating them as belonging to the business entity. Capital accounts represent the personal account of a proprietor or shareholders in the case of corporate bodies. Scope of recording. The entity concept allows businesses to determine what should be recorded and excluded from their financial records. It provides clarity on the scope of accounting for various transactions. Multiple books of business. Public entities often maintain multiple books of business, each catering to specific needs, such as IRS reporting, shareholders, or creditors. The going concern concept. The going concern concept assumes that a business entity will continue to operate for the foreseeable future without liquidation or significant scale reduction. Key points to consider. Assumption of continuity. Under this concept, the business is viewed as a going concern, and there is no intention of winding it up. Valuing assets. Assets are valued based on the going concern assumption. Accountants do not record the forced sale value of assets. Instead, they prefer historical cost, ensuring objectivity and verifiability. Depreciation. Depreciation of assets is based on their expected useful life, not their market value. This approach aligns with the idea that depreciation is an allocation process rather than a valuation. Supporting valuation. The going concern concept forms the foundation for asset valuation and depreciation provisions. The money measure concept. In accounting, every transaction is recorded in terms of money, and this is where the money measure concept comes into play. Monetary representation. All significant events and transactions must be expressible in monetary terms to be recorded in accounting books. Limitations. This concept poses limitations when non-monetary factors, such as employee well-being or product quality, cannot be quantified in monetary terms and are, therefore, not recorded. Handicap for decision-making. The money measure concept can handicap the usefulness of accounting records for management decisions, especially in cases where non-monetary factors significantly impact performance, like in commission-based roles. Recording at money value. Transactions are initially recorded at their money value on the date of occurrence, with subsequent changes in money value often being disregarded. Conclusion. Understanding these fundamental accounting concepts is essential for professionals in the finance and accounting industry, particularly those dealing with public entities. The entity concept defines how transactions are recorded, the going concern concept influences asset valuation, and the money measure concept sets the monetary framework for accounting. These concepts collectively shape the way financial information is reported and analyzed in the world of finance. Unraveling the intricacies of money valuation and accounting concepts. Introduction. Money is a fundamental aspect of our lives, and its valuation plays a pivotal role in our financial systems. In this article, we will delve into the concept of money valuation and explore key accounting concepts that significantly impact financial decisions and management strategies. We will demystify complex financial ideas and provide real-world examples to enhance your understanding. Money valuation, beyond cash in hand. Money valuation is a concept that extends far beyond the physical cash in your wallet. It encompasses various forms of money within the banking system and Federal Reserve. Here's what you need to know. Money in the banking system. When we talk about money valuation, we're referring to money within the banking system, not physical cash you use daily for expenses. Money's buying power. Money's value fluctuates depending on where it is within the financial system. Money held in an M3 asset category, like within the United States, has the most buying power, while money withdrawn from ATMs has less. Insurance and asset protection. Money in the M3 category often comes with insurance attached to it, safeguarding its value. As money circulates, it may lose its buying power, making insurance a vital component of financial transactions.